Alright everyone, let's break down this trade and go over why it was a high quality setup. Now before we dive in, I want to mention that I've been using micros over the past several weeks or so as an added risk management measure more than anything, given the market's tariff-induced volatility. Now looking at the 2-minute time frame here, and as I always mention and emphasize, actually don't get fixated on just one part of the chart that looks interesting to you from a price action standpoint. Instead, analyze the whole picture from left to right, since I think that's the only way to objectively evaluate the market's bias. All right, so starting over here, the first important clue that market makers were leading toward a long bias rather than a short one was, as you can see, the area around the 800 level here, holding as support. More importantly, I should say, if you compare the demand versus supply ratio between these two directional attempts, the longs have clearly dominance in terms of price progress. What's even more interesting is that this bullish tendency becomes apparent when price, after bouncing off the 800 level, starts surging via these higher lows, again with buyers driving the move. Now obviously we have this reversal attempt at the 870 level, but even this one was nothing more than a fake market maker move, which is basically a balancing act before they continued pushing price higher. Now, before we go further, notice the broader tendency in price movement, which is higher highs, higher highs. Now, this pattern certainly looks bullish, but this alone doesn't mean we blindly jump in long. What it does tell us, however, assuming that this part of the price structure hasn't developed yet. So what does it tell us is that we now have this easily identifiable range formation with the 800 level acting as a possible short-term base, given its flip zone viability that we have here. For those of you new to trading, a flip zone is basically a price level where support and resistance reverse roles, like in this case, resistance, as you can see, becomes support. Now this range here is important, not only because it highlights key levels of support and resistance, but also because it identifies the 870 level as an equilibrium point. This makes it particularly valuable, I should say, for assessing whether the market is oversold or overbought. Obviously, we still need further confirmation on the market's long bias here. However, judging by this first part of the price structure, the 800 price level, which anchors this range, now serves as a key reference point, one that could lead, I think, to a higher probability setup if the right conditions develop. And by the right conditions, I mean we get a confluence of technical factors that would reinforce the emergence of a high quality or high probability setup. So after printing new highs up here, the market, as you can see, forms a double top and starts sliding. Now, in my view, this double top is more of a stop hunt zone leading into a distribution phase. The first clue of this assumption is this lower peak signaling weakening bullish momentum. This is then followed by these two clearly visible redistribution segments, with the first one marking the beginning of the markdown phase, and the second one, which frankly, as you can see, looks more like a dump at this point, confirming the transition from a distribution phase to a markdown phase. After that, we see a tight price compression over here, which, as you can see, unfolds into a sharp 50-point corrective move, finding support right at the 800 support level I mentioned earlier. Now, this is where things start aligning for a high probability setup. What initially looked like a double bottom now develops into a triple bottom with yet another successful retest of the 800 support level, as evidenced by this impulsive demand bar. Now, you guys have to remember that whenever you see a wide base like this forming, particularly if a flip zone is part of the action, it's often a strong indication that a reversal is in the making. However, a strong support level alone, even though significant, doesn't justify, in my view, an automatic long entry. At this point, what I'm looking for is a technical confirmation, actually, some kind of pattern or identifier that, signals to me that this base will hold and trigger at the same time a bullish move. And that's when it clicked. This double bottom, as you can see, which evolved into a triple bottom, marked the end of this markdown phase I mentioned earlier. And naturally, once exhaustion sets in, the next logical expectation after markdown is either accumulation or sideways consolidation. And sure enough, as you can see here from the action, the market confirms this by first chopping a bit around here before seemingly breaking down via this wick to shake out weak hands and tap at the same time into additional liquidity from the 760 imbalance zone over here. Now, this liquidity grab via this rejection wick, that is clearly another clue of the market's long bias, sets the stage, in my view, for a sharp upward move, driving price, which at this point was trading in oversold territory, so driving the price impulsively to the upside. Guys, this is a classic example of using Wyckoff's market cycle phases, where in this case the markdown phase reaches exhaustion and leads to the identification of a strong buy signal. As you can see, the trade performed really well, with my intended target being successfully hit. Obviously, it goes without saying that it's always satisfying when a well-planned strategy pays off. By the way, guys, if you found this trade analysis useful, be sure to stay tuned for my upcoming video, in which I'll be sharing more insights or similar setup strategies that you can apply if you want, obviously, to your own trading. Alright, gang, thanks for watching, and as always, hope to catch you all in the next one.